The world of finance is a vast and complex machine. It's easy to get lost in the abstract. Stocks, bonds, derivatives, these things can feel like numbers on a screen. Commodities are different. They are the physical goods that underpin the global economy. We're talking about oil that fuels our cars, wheat that makes our bread, and gold that has been a store of value for centuries. These are not just financial instruments. They are real assets with inherent value. When you trade commodities, you're trading a piece of the physical world. This tangible nature sets commodities apart from the world of equities and fixed income. It also makes them subject to a unique set of risks and opportunities. Imagine a farmer in Iowa planting corn. He's worried about the weather, the soil, and the price he'll get for his crop. Now imagine an investor in New York buying corn futures. She's betting on the same factors, but she'll never touch a single ear of corn. This interplay between the physical and the financial is what makes commodities so fascinating. This is the world we're diving into, the world of barrels and bushels, of supply and demand, of geopolitical tensions and natural disasters. Fasten your seatbelts. It's going to be a wild ride. In the financial world, it's crucial to understand the underlying asset. Stocks represent ownership in a company, a piece of paper that says you own a sliver of Apple or Google. Bonds are essentially loans. You're lending money to a government or corporation with the promise of interest payments and principal repayment. Commodities are different. They are tangible goods. Oil, gold, coffee, sugar. These are things you can touch, see, and in some cases even taste. This inherent value sets them apart from financial instruments that derive their value from future cash flows or contractual obligations. Consider gold. For millennia, it's been a store of value, a hedge against inflation, a safe haven in times of crisis. Its value is intrinsic, tied to its scarcity, durability, and beauty. Stocks can go to zero. Bonds can default. Gold will always be gold. This isn't to say commodities are without risk. Far from it. But their value is rooted in something real, something tangible. This makes them a fascinating and potentially lucrative asset class for investors seeking to diversify their portfolios. This difference between tangible goods and financial representations is fundamental to understanding the dynamics of commodities markets. It's the bedrock upon which everything else is built. The commodities markets are a melting pot of participants. You have the producers, the farmers growing wheat, the miners extracting copper, the oil companies drilling for crude. These are the folks on the front lines, dealing with the physical realities of supply and demand. Then you have the consumers, the food companies buying wheat, the manufacturers using copper, the airlines needing jet fuel. They rely on a steady supply of commodities to keep their businesses running, and they're often willing to pay a premium to secure that supply. And then there are the traders. Some are hedgers, like the farmer locking in a price for his crop or the airline protecting itself against rising fuel costs. Others are speculators, betting on price movements and trying to profit from volatility. This mix of producers, consumers, and speculators creates a dynamic and constantly shifting landscape. It's a high-stakes game where information is king and timing is everything. And it's this diversity of players that makes the commodities market so fascinating and unpredictable. Commodities trading takes place on organized exchanges and in over-the-counter (OTC) markets. Exchanges, like the Chicago Mercantile Exchange (CME) or the London Metal Exchange (LME), provide a centralized platform for buyers and sellers to come together. These exchanges offer standardized contracts, ensuring transparency and liquidity. Think of it like a giant auction house for oil, gold, or soybeans. Prices are determined by the forces of supply and demand, with every trade contributing to the overall market price. OTC markets, on the other hand, are less formal. Trades occur directly between two parties, often through brokers or dealers. This allows for greater flexibility in terms of contract size, delivery dates, and other specifications. Imagine a large energy company negotiating a long-term supply agreement for natural gas with a producer. This kind of deal, tailored to specific needs, would typically happen in the OTC market. Whether on an exchange or OTC, the commodities markets are constantly buzzing with activity. It's a global marketplace where fortunes can be made and lost in the blink of an eye. Volatility is the name of the game in commodities. Prices can swing wildly, driven by factors both predictable and unforeseen. A late frost in Brazil can send coffee prices soaring. A labor strike in a Chilean copper mine can disrupt global supply chains. This inherent volatility can be unnerving for some investors, but it also creates opportunities for outsized returns. Successful commodities traders have a deep understanding of the underlying markets. They closely monitor supply and demand dynamics, track weather patterns, and analyze geopolitical events. For instance, consider the oil price spike of 2008. As global demand surged, driven by China's economic boom, oil prices skyrocketed. Traders who anticipated this supply-demand imbalance were handsomely rewarded. Those caught off guard faced significant losses. Commodities trading is not for the faint of heart. It's a fast-paced, high-risk environment where knowledge is power and timing is everything. But for those who can stomach the volatility, it offers the potential for substantial rewards. Commodities markets are uniquely sensitive to global events. A political upheaval in the Middle East can send oil prices soaring. A drought in Australia can impact wheat production, leading to price spikes in bread baskets around the world. These real-world events can create ripple effects that reverberate throughout the global economy. Remember the Arab Spring uprisings of 2011? The political instability in the region, a major oil producer, sent shockwaves through energy markets, impacting everything from gasoline prices to airline ticket costs. This interconnectedness between commodities and geopolitics is a constant. Understanding these dynamics is crucial for anyone involved in commodities trading or simply trying to make sense of the global economy. Commodities markets attract a diverse range of participants, each with their own motives and strategies. Some are driven by the need to hedge, to protect themselves against adverse price movements. Others are drawn by the allure of speculation, seeking to profit from volatility. Hedgers are like insurance buyers. An airline, for example, might use oil futures to lock in a specific price for jet fuel, protecting themselves against potential price increases. Similarly, a farmer might sell corn futures to guarantee a certain price for their crop, mitigating the risk of a market downturn. Speculators, on the other hand, are more like gamblers. They bet on future price movements, aiming to buy low and sell high. They thrive on volatility, using their market knowledge and risk appetite to capitalize on price swings. This interplay between hedgers and speculators is what makes commodities markets so dynamic. Hedgers provide a base level of liquidity, while speculators inject volatility and opportunity. It's a delicate balance, but one that's essential for the functioning of these markets. Commodities don't exist in a vacuum. They are part of a complex and interconnected financial ecosystem, influencing and being influenced by other asset classes like stocks, bonds, and currencies. For example, a rise in oil prices can impact inflation, leading central banks to raise interest rates. This, in turn, can affect bond yields and stock valuations. Similarly, a strengthening dollar can make commodities priced in dollars more expensive for buyers using other currencies, potentially impacting demand. Understanding these intermarket relationships is crucial for navigating the complexities of the financial world. A savvy investor doesn't just look at commodities in isolation, but considers how they fit into the broader economic landscape. It's like a giant game of chess, where each move can have far-reaching consequences. Mastering this game requires a deep understanding of the rules, the players, and the stakes involved. The world of commodities is constantly evolving. New technologies, shifting consumption patterns, and geopolitical realignments are reshaping the landscape, creating both challenges and opportunities. The rise of renewable energy sources, for instance, is gradually reducing dependence on fossil fuels, impacting long-term demand for oil and gas. The growing global middle class, particularly in Asia, is driving demand for agricultural commodities and industrial metals. Technological advancements, like precision agriculture and sustainable farming practices, are transforming how commodities are produced and traded. These innovations are improving efficiency, transparency, and sustainability across the industry. Navigating this evolving landscape requires adaptability, innovation, and a willingness to embrace change. The future of commodities belongs to those who can anticipate and capitalize on emerging trends, shaping the industry for decades to come. Commodities are the lifeblood of the global economy. They are the raw materials that fuel our cars, build our cities, and feed our families. Understanding these markets is not just about financial gain, it's about comprehending the forces that shape our world. From the farmer in the field to the trader on Wall Street, countless players participate in this intricate dance of supply and demand. Their decisions, driven by a complex interplay of factors, weather patterns, geopolitical events, technological advancements, ripple through the global economy, impacting our daily lives in profound ways. Commodities trading, with its inherent risks and rewards, offers a glimpse into this fascinating world. It's a constant reminder that behind the abstract numbers and charts lie real goods, real people, and real-world consequences. And that's what makes it so compelling.